All right, I think we are live. Welcome back to another live stream, guys. And today we're gonna cover 10 biggest headlines that is happening right now. And first up, we're gonna cover like Warren Buffett urged SEC to scrutinize a SpaceX IPO. She is really going after billionaires. She does not like any billionaire, and we're gonna go into a little bit detail on how she does it. And one of the robotic startup, Neura Robotics secured a $1.4 billion in funding, and Xbox also plans on major cuts on the kind of the gaming division. Got a lot to go cover today, but the first thing we want to kind of go over is just a broader market overview. So the market slide amid geopolitical tension and hotter inflation data. So we are looking at inflation coming in accelerate at 4.2%, rising oil prices, heightened concern about energy driving inflation, pressuring risk assets across global markets. Gold, silver, and Bitcoin also fell 1 to 2%. So the consumer index is marking like 3-year high from 3.8% in April, and driving heavily by the ongoing conflict with Iran. The energy price account for roughly 60% of overall monthly increase. With domestic gas price surging to a national average of $4.50 per gallon due to disruption in the Strait of Hormuz. But base inflammation also leak into logistics, causing airlines fares to spike 26% annually. So the airplane tickets you think about vacation cost $26 more. You spend over $100, it'll be $126. Pretty steep. In response to data in the escalating geopolitical tension, the Dow and Nasdaq both dropped over 1.5% in the intraday trading. So overall, today the market is not looking that well because of the geopolitical tension regarding the war, and then the price of inflation, especially the gas, just keep going up. Leave in the comment section below is the gas price and energy price hitting and really hitting your wallet. It's pretty steep, or not really bothering you that much. Warren urged SEC to scrutinize SpaceX IPO plans. So Warren, the Senator Elizabeth Warren, filed a citing, but kind of urged SEC to delay SpaceX IPO, citing main concern is valuation, governance, and conflict of interest concerns. Also, another person, source seller Jen Channels, also urged that SpaceX plans $1.75 trillion IPO valuation is driven by hopes and dreams rather than fundamentals. So the Senator Warren sent a formal letter to the SEC demanding intense scrutiny on the upcoming listing, pointing to overlapping corporate leadership and potential conflict of interest regarding mass multi-company oversight, which is SpaceX, Tesla, XAI, and X. Concurrently, legendary source seller Jim Channels publicly questioned the viability of eye-popping 1.75 trillion valuation target. Channels are that the valuation treats SpaceX as a high margin software business rather than a capital intensive aerospace and hardware manufacturer. Critics note that while Starlink satellite internet revenue is growing rapidly, the immense capital expenditure required to build and maintain the Starship fleet do not yet justify a nearly $2 trillion market cap under current fundamental cash flow. So currently, I just think that overall the space building a rocket is extremely expensive. And they are right. It's just very cash eating kind of business. You're not gonna generate any positive cash flow, so it's a pretty big danger zone. But Elon is in this boat before with Tesla, right? Building a car and the manufacturing car is extremely cash not intensive. But now look at Tesla. They are cash positive, cash flow positive. So Jen Chenos hated Tesla, but he was wrong. And Jen Chenos also hates SpaceX. Will he be wrong? And this time too, we just have to wait and see if SpaceX can actually turn into profit with the AI satellite and space, and then the Starlink, and then also the more crazier the asteroid mining too. So many different crazy science fiction ideas that you just feel like it's not even possible. But don't ever bet against Elon, right? Look at Tesla, one of the most successful electric car companies, and look at SpaceX. It can land rockets on its own, but now SpaceX is venturing out into a different kind of spectrum. So I'm just gonna wait and see how that play out. Considers price cuts as competition intensifies. So OpenAI is considering like major price cut for usage to compete with Anthropic as enterprise push back on the cost. Lower pricing could accelerate adoption but may pressure margins. So as large enterprise increasingly demand enterprise grade efficiency, they are pushing back on the high cost of running proprietary API models at scale. Anthropic has successfully lured enterprise clients by optimizing the cost to performance ratio as Claude model, forcing OpenAI's hand to prevent churn and maintain market dominance. So OpenAI is dragging aggressively pricing rollbacks for token usage. While this structural price cut will undoubtedly make advanced AI integration accessible to similar business and accelerate mass adoption, it raised warning flags for when venture capitalists running massive clusters of GPUs remain incredibly expensive, and dropping price could severely compress OpenAI's profit. So that's one of the reasons that um, OpenAI is also going in public. They just filed the S1 to go in public because they need that money to compete with Anthropic and also XAI. They and the Gemini, right? Because if you're falling behind, nobody gonna use it. Because if you limit the usage too much, everybody just go to a different platform. So once OpenAI runs out the money, they are in a really tough spot. So right now it's the AI boom, so they are raising more money to feed into that machine because people use it for free for now, but later on they need to just continue to monetize the user. So I just gotta be really careful on this. I need to sound the alarm here because OpenAI is still not profitable. So if you invest in OpenAI, just invest with caution because if investors decide to not give OpenAI any money, we are in a they gonna be in a really big pickle. Salesforce on plans for massive AI spending. So not only OpenAI is spending more, Oracle reported earnings and revenue expectation with cloud revenue up 47% and cloud infrastructure revenue up 93%. However, sale fell after Oracle said it's planned to raise another $20 billion and spend about $70 billion on AI infrastructure in the fiscal year of 2027. In other news, Oracle was selected to provide a government-wide cloud HR platform too. So they're getting many deals. So Oracle posted like really great blockbuster fourth quarter results. Overall, revenue is rising like 21% to $19.2 billion, fueled by astonishing like 93% surge in Oracle cloud infrastructure. And the revenue has for the cloud infrastructure is jumped by 400% because of its multi cloud database booking. However, Wall Street is kind of panicking over the sheer scale of Oracle capital intensity. Management revealed a net cash capital expense budget of $70 billion, aggressively secure land, power, and chips for the data center. To fund this, Oracle planned to raise 40 billion in financing, including a freshly 20 billion stock and debt expansion, triggering immediate dilution and balance sheet concerns. So this is kind of like the reality of companies that is getting massive right from customers, and they need to expand quickly. How do they expand quickly? By diluting the shareholders that is holding the stock. That's why the Oracle stock is dropping in a pretty decent amount. So I know like there's massive demand, so Oracle want to meet that demand. Um, And I think they're doing it right for the whole kind of the directors, because they are enriching the balance sheet by getting the money from the shareholders. They're not giving money to the shareholder. They're taking the money out of the shareholder pocket. That's why they're diluting the market for that capital intensive kind of building the AI data centers. So um, I think they need the capital, but I wish they could do it a little bit more in a linear way, because if you raise that much money and including some debt, the interest rate will eat them alive. So gotta be really, really careful. Next up, we got something interesting. Cracker Barrel is have a turnaround effort to boost kind of the overall profit margins. So looking into Cracker Barrel, they posted a surprise Q3 profit and raised full-year revenue and EBITDA guidance after cost cut offset weaker sales. So the sales rose despite continued kind of traffic decline into the kind of the store. So the restaurant chain is aggressive in a kind of an aggressive turnaround strategy to yield fruit, reporting a positive third quarter net income that beat Wall Street consensus estimates. The profit surprise wasn't driven by microeconomic like recovery, but by dramatic internal efficiency measures, including menu streamlining, labor optimization, and supply chain rationalization. So they really, really simplified the whole menu, right? If you remember, Cracker Barrel came out with a very, very kind of radical logo, right? If you look back into Cracker Barrel and the logo, it was nobody really liked it, and they had a lot of heat over it. But they got rid of a lot of leadership and continue to turn around the overall kind of the restaurant field, and they are really focusing on the core message, which is the food and the service. If you get these two right, customers will continue to walk into the door. Um, so great job on Cracker Barrel leading the way to for a recovery, and the market and the restaurant is just very, very competitive for food industries. If you look at some food industries like Applebee's, right? And then also Colton's. They offer Colton's is one of my favorite restaurants. They offer some of the great kind of the best steaks, and the service is very fast. And also Texas Roadhouse. If they can duplicate that experience from like Texas Roadhouse and the Cracker Barrels to Cracker Barrels, they got this is gonna be a winning restaurant for sure, like for many years to come. Um, Next up, we got face cuts as Microsoft restructures gaming units. So, Microsoft division is reporting planning to significantly lay off and budget reduction next month as it's restructured under new leadership. So, following its massive $69 billion acquisition of um, Activision Blizzard, Microsoft is aggressively moving to eliminate redundancy and improve the profitability of its gaming ecosystem. Under its newly appointed leadership tier, Xbox is targeting deep cuts across its marketing, publishing, and hardware development division alongside scaling back budgets for several unannounced first-party gaming titles. The restructuring signals a strategic pivot away from hyper-aggressive growth and toward maximizing margin on its Xbox Game Pass subscription service and cloud gaming platform. So they're kind of waking up here right now because they spent $69 billion to buy that Activision Blizzard, right? And the games are great, but it's very capital intensive. So they realized that you cannot just keep losing money on this. So they decided to just, hey, let's cut the loss, shrink down the overhead, and let's make it a leaner company overall. Tesla wins approval for self-driving software in Belgium. So, um, Tesla received the approval to deploy its full self-driving supervised in Belgium, Europe, which will be the third European market after Netherlands and Lithuania. So, Belgian regulatory law marks another incremental but vital win for the Tesla's European expansion. Navigating Europe's strengthened kind of strict UNECE vehicle regulations has historically delayed Tesla's autonomous ambitions on the continent, but securing access to Belgium alongside the Netherlands and Lithuania, Tesla is building a geographic cluster in Western Europe to gather real-world driving data on European road layout, signage, and cyclist behaviors. This expansion is critical to proving the safety of the vision-only supervised FSD system to more conservative regulators in major European autonomous markets like Germany and France. So they really just have to prove to the countries that full self driving is valuable and also safer than human driving. But every single country, like Europeans, right, they got a cyclist, they got motorcycle, they got people walking. And inside European country, they drive on the left side of the side. It's flip flop in many different kind of scenarios. And I think Tesla is winning a ground, and Belgium could be a key play because of the kind of the way the street is set up. It get a lot more data for Tesla to train its neural network to continue to expand into more European countries to capture more markets and give just a little bit more experience to kind of edit the full FSD to a better, more defined driving experience. Uber says that New York law risks passenger safety. So what kind of law is Uber fighting? So Uber is just sued New York City to block a driver protection law, arguing it would make it harder to remove unsafe drivers and expose the company to legal risk. So Uber filed a lawsuit in federal court against New York City Taxi and Limousine Commission over a new ordinance to limit when and how rider ops can deactivate driver accounts. The law mandates a strict appeal process before a driver can be barred from the platform. Uber's legal complaint argued that the law severely restricts its ability to swiftly remove drivers accused of safety violations, sexual harassment, and dangerous driving, thereby directly compromising passengers' safety. Furthermore, Uber contends that the city's interference creates immense corporate liability, exposing the company to massive personal injury lawsuit if a flagged driver commit a crime while the deactivation is tied up and kind of in the process of appeals. So it sounds like the news really making it harder for kind of the Ubers to kick off some of the drivers, which is kind of a win for the drivers, but although at the same time it does make it less safe, right? Because Uber, if they can remove some of the bad apples, you want to have a really good experience overall. But it's you're making it harder. The bad apples will stay longer. So that's the only downside is bad. I'd rather remove the bad apple, you know, even if like removing removing some good pieces of the good apples, right? But sometimes overall, you just make the whole experience better, right? But next up, we got JP Morgan expands use of AI agents across operations. So, JP Morgan plans to deploy more advanced agents this year that can operate autonomously for hours and manage complex workflows. The bank says AI is already boosting private banking sales, moving beyond a simple LLM chatbot. JP Morgan is rolling out a highly sophisticated agentic AI workflow capable of multi-step reasoning, executing trades, reconciling cross-border regulatory compliance, and managing complex internal back-office pipelines without human intervention for hours at a time. The Wall Street giant revealed that its internal integration of specialized tools has already materialized to boost productivity and wealth management sector. So everybody is really adopting the AI kind of landscape. Kind of like if you look at the Oracle, they're dramatically expanding it because if you don't adopt it, make the workforce more efficient, they just feel that you're gonna be left behind. So news is pretty normal that every single sector, even from restaurants to finance to marketing. Everybody is using part of the AI. Even this live stream here, I using some AI to really speed up how I kind of present, how I present and speak and writing. Everything is AI. If you like it or not, but AI is just a part of life now. Headline of the day: invest the big on a humanoid robotic startup. So a robotic startup called Neura Robotic raised up to $1.4 billion in funding round backed by Nvidia, Amazon, Qualcomm, and others, valuing the humanoid robotic company at about $7 billion amid booming investor interest in the AI-powered robotics. So this is a German cognitive robotic company secured a massive Series C funding round that could max out a $1.4 billion, solidifying its place as a premier European contender in the global robotic race, backed by a powerhouse syndicated including Nvidia, Amazon, and Qualcomm. And Neura's valuation has soared to approximately $7 billion. The first capital will be poured into producing its flagship full NE1 humanoid robot and expanding the Neuraverse, an open share cloud brain ecosystem that allow robotic deploy worldwide to instantly share learn physical skills and workflows. So big techs are is just one of the highlights that big techs are really kind of applying these robotics and funding it. So, but the only downside here is that robotics they're still in early stages of kind of development, and they are not generating sufficient revenue. If you look at example, be like Canoe, right, the electric car company, and they're not really producing revenues, but they just secure funding and kind of backlog of people ordering it. But if you look at Canoe today, it's bankrupt because building a robot is like building a car. You need massive capital and massive funding to build factories, right? To make sure that software works and to make sure that training data works. So I will not be surprised in like 5 years this company might go bankrupt, or in 5 years a low chance that this company still survive and be one of the biggest company in Europe. One or two things happen, but most likely it might go bankrupt but at the same time, the CEO, the founder, gonna be very filthy rich. You just gotta be careful. These companies, right? You want to make sure they have some kind of earning and huge, strong balance sheet. But yeah, that is the end of the video. Hope you guys enjoyed it. If you make it this far, don't forget to give this video a big thumbs up and make sure to hit that subscribe button. And yeah, if you want more of the top 10 news headlines, make sure to hit that subscribe button. It really means a lot to me. But yeah, my name is Calvin, and I see you guys next one.